Guys, we've had quite a few questions on what exactly is the spread fragmentation in the Eurozone that we've heard so much about and that you guys have heard us talk about so much in the past couple of weeks. Now, right now, the ECB is in a really tough spot because they have to hike rates and remove accommodation from the economy. And they have to do so because they need to try and fight inflation that has gotten out of control. But obviously, in doing so, they also run the risk of causing fragmentation in the spreads between member countries within the Eurozone. So when we talk about spread fragmentation, we're basically talking about the spread between certain individual countries' bond yields within the Eurozone. Now, to understand this problem, to best describe it, we need to look at individual countries as opposed to looking at the Eurozone as a whole. The problem facing the Eurozone is that they have a monetary union, meaning that the ECB controls monetary policy for the Eurozone, but they don't have a fiscal union, meaning that each country runs its own fiscal policy. Now, there is some controls set in place which member states need to adhere to, but these big differences in fiscal policy and fiscal well-being really has in the past created massive debt problems. If you consider what happened back in the sovereign debt crisis back in 2011 and 2012, these are things that not too long ago risked some serious problems for the Eurozone. So that's why the markets pay attention when things like spread fragmentation shows up. So think about it this way. Let's take the BTP-Bund spread. Now, this is the spread basically between the Italian 10-year bond and the German 10-year bond. And when you think about these two countries, when you think about Germany and a place like Italy, would you rather invest your money in a country like Germany, which has a very low risk of defaulting and is considered a safer option? Or would you rather invest in a country like Italy, where you have higher default risks and have a less sound financial and fiscal stance? Well, the answer, of course, is quite simple. It's Germany, as long as you get the same yield. Because there is the question of yield, that if you invest in something that's higher risk, you obviously require a higher reward. If you have been offered the same amount of yield to invest in Germany versus that of Italy, you will of course always choose the safer option, Germany, unless you have different reasons for investing in a higher risk option. So what would change your mind to invest in Italy over Germany is, of course, if Italy offered you a much more attractive yield. So a country that has a higher default risk and is less financially sound will basically need to offer higher yields to make their bonds more attractive, basically attractive enough for investors to offset some of that risk. Think about it. That's the same thing that really emerging market bonds need to do. Those countries need to offer much higher yields because you need to offset a lot of that political risk that is associated with investing in that country. So basically, investors will require to be compensated with a higher yield for taking on more risk. So with this in mind, the reason why the BTP-Bund spread is such a closely watched spread among market participants is because you are comparing the risk-free rate from the German Bund yield with that of the higher risk Italian BTP yield. Now, when the spread rises or widens, it's usually a bad sign. And when the spread falls or narrows, it's usually a good sign. So keep in mind, though, that the spread obviously has two cogs. It's not just the Bund and not just the BTP. You have both the Bund as well as the BTP. That means that the spread can narrow or widen for more than one reason. It can narrow or widen if one of the yields move while the other one stays flat. So you need to figure out what the reasons are for any sudden rips or falls in the spread, because the reason is far more important than the move itself. So for example, the spread can rise and fall rapidly without anything to do with monetary policy. And it could potentially just be politics. Like we saw back in 2018, with all of the political instability we had in Italy, the spread rose drastically due to the markets stressing about what we call redenomination risks. Now, that's just a fancy way of saying that there's risk that the country could leave the Eurozone, much like we saw with UK and Brexit. So back in 2018, there was a lot of growing concern about Italy's fiscal stance, about the deficit, and the EU actually rejected the Italian government's budget proposals at that time, also opening up an excess deficit procedure against Italy. So that was a really stress point, and that saw a big rise in the spread. not because of higher inflation or tighter monetary policy, but mainly due to the political uncertainty with growing risks of an Italian exit of the euro area. So it's important to understand that it doesn't just move up and down based on monetary policy, it can move up and down based on politics as well. Now, in the current situation, the current context that we have both the Bund yield as well as BTP-Bund or BTP yields rising. And the reason they are rising rapidly is because we have massively high inflation that is, of course, sparking expectations that the ECB will need to hike aggressively. Now, the other important part to consider is that quantitative easing has stopped, which means that the ECB can no longer help out countries like Italy by buying their bonds, especially with the more lenient way that they were allowed to purchase specific countries' debt under something like the PEP program. So both the Bund and BTP yields are rising right now due to inflation and hawkish policy. But the higher the Bund yield goes, the higher BTPs need to rise alongside it to make sure that investors still find the yield competitive with the one offered by the risk-free option when you compare BTBs with something like the Bund. Again, which one would you invest in? If the German Bund yield offers you a very attractive yield, you would much rather invest there as opposed to investing in a place like Italy. So you need to really understand that when the Bund yield is rising due to monetary policy expectations, the BTB needs to catch up. It needs to offer higher and higher yields to make sure that those bonds stay attractive. Now, the overall effects of a rapid rise in the spread, it's normally not something that will show up immediately in the economy, right? The transmission effect can take some time, but the impact that it has is quite clear. As yields rise in anticipation of higher inflation and tighter policy like we have right now, when that forces Bund yields higher, BTBs are forced to grind even higher to stay competitive. And the problem is that the higher the yields goes, especially the BTPs, the bigger the problem becomes for the indebted Italy economy, because borrowing costs will rise alongside those rising yields. So remember, 10-year yields are used as a benchmark for other borrowing costs. So as they rise, it'll hit consumers, it'll hit businesses from a borrowing cost perspective, but it will also hit the government. Because remember, when a government issues bonds for the first time in the primary market, they issue them to big buyers out there. And once that bond has been sold and issued in the primary market, it goes into the secondary market where it can be traded. Now, this is very important to understand, because as the yields rise higher and higher, the current ones that's in the current yield, it means that any newly issued debt that the government will want to sell will have to be issued at those higher yields to make them competitive, which means that higher borrowing costs for the government on any newly issued debt. So you have a debt problem, which becomes a bigger debt problem, which becomes a bigger debt problem as yields continue to rise. So now that you understand that background, the spread fragmentation basically just refers to the rapid widening of the spread, the climbing of the spread between the German Bund and something like the BTP yield. In order to try and stop the spread from widening and causing, possible financial and political instability, the ECB has promised us a new tool to try and stop unwanted and destabilizing spread fragmentation from occurring. The problem is, what will this tool look like? What will it encompass? They have a few options on their hands on how to deal with it. The most popular idea is that they can reinvest maturing assets under the PEP by basically disproportionately buying debt from other countries where the spread can negatively impact the bank's transmission policy, basically buying more debt from Italy and places like Spain, etc. However, according to a few participants, that just won't be enough. So the big question is, what magic tool can they come up with? What magic tool can they come up with that will provide enough flexibility, that will provide enough ambiguity, that provides enough conviction, and obviously provides enough legal grounds to at least have the appearance of something that could fix spread fragmentation before it leads to bigger problems like we had back in 2018 and obviously back in 2011. But that's a little bit more detailed than what we are referring to when we say spread fragmentation, but I think it's important to understand the broader context. It's basically, when we say spread fragmentation, it's just a fancy way of saying that it's the spread between a low-risk country like Germany, their bonds, and a high-risk country like Italy, their bonds in the Eurozone. If this spread is rising, that's obviously it's a cause for possible spread fragmentation. Just means that based on the very different fiscal fiscal standing for these two countries, if those spreads rise too rapidly in a place like Germany, it has massive implications for a place like Italy. Also, keep in mind that the euro, the reason why this is important for us from a currency perspective, of course, is that the euro, if you see the euro currency index here in blue, it's normally inversely correlated to the spread. So, as with most correlations, though, it's far from perfect, and you can't use the spread on its own for directional biases for the euro, because the reason for the widening and the narrowing of the spread, like we said, is very important. It's more important than the level of the spread itself. It's also the rate of change of the spread that's more interesting. In other words, if it narrows, but it narrows, very slowly and for different reasons, or widens very slowly and for different reasons, it's probably not going to have too much of an impact on the euro. But it's when you have those very aggressive, those very punchy, big rate of change, big standard deviation moves, that's when it can trigger bigger impact, and get the market's attention. And obviously, that in those situations, you can have far bigger impacts in things like the euro. Just look back at this chart. Every time we had those big blowout moves to the upside, you've had very sharp moves, very fast and sharp moves to the downside in the euro. So again, when it's done with the when it happens as a result of a specific catalyst, it'll obviously tell you whether it's going to be negative for the euro and how negative it's going to be for the euro. But just the move itself, if you have a very sharp, big move higher or lower, it normally can have a bigger impact in the euro from a transmission effect perspective. So hope that helps with all of the questions. As always, any others, don't hesitate to let us know.